things that are considered risky, buying in mining towns or areas that don't have that kind of long-term sustainability. So hey guys, Justin to pick it back with you for another video. Just wanted to chat to you about how to reduce your risk when purchasing a property. So obviously when we're purchasing a property and we're in a financial scenario, the banks are obviously going to look at our scenario really from a risk perspective to see if they want to take it on and what's going to be a safe bet to them, essentially. So things that are considered risky, buying in mining towns or areas that don't have that kind of long-term sustainability and might be a new off-the-plan purchase, as well as another thing that can be considered risky to a lender. And if we're looking at both of those things of being in a mining town, off the plan, and with a very small deposit, so doing a 90 or a 95% lend, that's a very risky bet for a bank. The other things that would be considered risky to lenders is if you've got bad credit, not a good conduct, issues on your statements and things like that. So late fees and things like that as well are really all these things that will have a look at your risk category profile. Not having a strong asset position is another thing too. So not really having much in your superannuation or not much savings based on your age, postcode and all those type of things really will increase your risk rating. So I suppose how do we avoid that? We want to be doing the opposite. So making sure we've got good conduct when we're obviously going ahead for finance, making sure everything's paid on time, that there's no issues with your credit scoring, and making sure you've got good satisfactory history on your repayments. We also want to be looking at if we can do a bigger deposit rather than say doing a 10 or a 5% deposit. If you do a 20% and we're not using lender's mortgage insurance, that's a lot safer to a lender. So most policies and lenders will go outside of their policies or look at things by exception if you're doing a 20% deposit. So 20% deposit is a lot safer for the lenders, and they sometimes will give you a slightly cheaper interest rate on that side as well. The other side of that too is really making sure that you're buying an asset that's in a good location, so metro, not looking in regional, not looking way out west and there's a lot of speculation. You want to be looking in these areas that have that solid foundation. They're existing, there's plenty of people there, there's plenty of comparable sales and things like that, so the banks know the actual metric of it as well. And the other thing is also buying an asset that's going to perform and increase in value over time. So, if you do a 20% deposit on a property worth, 300,000 and you get a loan of 240,000, if that property then, obviously goes up to say 400,000 as an example, then obviously your LVR, your loan to value ratio, decreases, which means it's more of a safer bet. So you've got an asset that's worth 400,000 and there's only owing of say 240,000 on it, you're going to have a pretty low debt to income ratio there of only about 60%. So that's something that really is going to be a lot stronger to the banks, and then they'd be willing to lend you more and obviously have a look at your asset position as well. So those are some key things to maybe look at if you're trying to increase your credit profile or that risk position on where you're at. But ideally if we do kind of start with buying as many assets as we can initially, yes, they might be considered risky, but then obviously hopefully they perform your boarding board areas over time. And as they increase, your loans are at 90%, hopefully around that 80, 75, 60% because the properties have increased in value over time, and then we can kind of draw back and get that equity out in due course. So yeah, if you're having issues with risk or credit profiling, stuff like that, if we need to look at lenders and have to look at things outside the box, or if there's any concerns that you have that you think, I'm not sure if a normal lender's going to look at it or you've been knocked back, certainly feel free to reach out to us and we're happy to take a look at it, see if there's a solution there for you. Appreciate your time. Cheers.